What's up, y'all? Welcome, welcome. It's a Wednesday afternoon. We're so glad you guys could join. We'll let you guys jump in, give you a few minutes to acclimate, get your audio all set up before we really dive in to all of the nuggets that we're going to share. So if you don't have a pen and paper, grab a pen and paper. There's going to be so much information shared. So get ready. We're excited that you all are here. Now, for those of you that don't know me, my name is Melissa Forbush. I am part of the investor relations team here at MF Capital Partners, and I'm stoked that you all have joined us. I'm so excited to introduce our new acquisition, the Arden Place Apartments. Y'all, this has a huge potential upside and early to market acquisition, which truthfully is exactly what you guys are looking for. So we're here to secure incredible passive returns for y'all. So welcome. Now, before I introduce the man, the myth, the legend, y'all know him, Mr. Ryan Woolley. But before I do that, I'm going to tell you a little bit. So Arden Place Apartments, it's located in Warner Robins, Georgia. Now, for those of you that don't know, it's an expanding, flourishing community, which truthfully it's the leading attraction for global companies, investments, and incredible talent. So the city offers job opportunities, education, culture, food, shopping. Listen, you guys know what we look for when we are acquiring properties. Warner Robins is the largest and fastest, the largest and fastest population growth on record, and it's only getting bigger and better. So you can see why we're excited about this, but we have Ryan, Mr. Ryan Woolley. He's gonna dive in, tell us all from an underwriting perspective and a market perspective, why this is such an incredible opportunity for you guys. So for those of you that are not as familiar with Ryan, even if you are, we want to hear about this man. So Ryan watched his grandfather acquire apartments throughout Sacramento all growing up. Now he saw that and Ryan, correct me if I'm wrong, but you saw that the quality of life that those assets provided, that your grandpa really put together, and that is really where the interest sparked. So he took that vision. He acquired a degree in accounting from Utah Valley University. Y'all, he's our numbers genius. He has a beautiful mind. He's been able to use that knowledge to start and maintain this successful real estate business. So what began as, the single family focus, which all too many of us can relate to, it's evolved into a portfolio of multifamily assets that span over, I believe, four different states just with Ryan. And he's been using this for 20 years. So he's the managing partner of over 400 million in assets. Y'all, he is the man that you guys want on this webinar. Is that a big enough introduction for you, Mr. Woolley?
Oh, shit. It's great. Absolutely great. Awesome. Well, listen, we're super excited about this. Melissa and I actually talked about before I actually get super nervous, right? Underwriters are people that, listen, we run numbers, right? We run projections, forecasting, seeing exactly how returns happen. We're not the best on camera, so this will be a first. And
whoa!
Come on.
No, that is false.
Just kidding. Awesome. So we want this to be very interactive today about opportunities. So first of all, I would love to know in the chat, where are you all calling in from, right? And how do you know MF Capital Partners? I would love to know those two things. Do we have the chat initiated, guys?
Yep. We should.
Come on, don't be shy. We've got 100 people on this. Don't be shy. Where are you from and how do you know MF Capital Partners? Meanwhile, I'm going to drink a Diet Coke. I don't know that the chat is going.
Okay, y'all, I'm not gonna lie. I don't usually change the chat, so you're gonna have to be patient. I will dive into this really quick, right? Let me see if I can get the chat initiated so that we can hear from all of these people. Let's see.
Awesome. Well, perfect. Hey, so I'll tell you a little bit about me. So like Melissa said, I actually grew up in the industry as we get this enabled. I grew up in the industry. I had a grandfather that owned quite a few apartments in Sacramento, California. Some of you heard the story. Some of you come from our education side. Some of you are new to MF Capital Partners. So, I grew up seeing my grandfather have a ton of wealth and through apartments. I've always been pretty decent at numbers. In fact, Melissa, I was the kid that in algebra class, my teachers used to always get mad. I could do the whole equation in my head and just put the answer in. And then
does that surprise anyone? That does not surprise me.
Ryan, you have to show the work, right? Ryan, you have to show the work. And so I was like, all right, but so I went into accounting, graduate accounting, knowing that would always help me. I actually started out in the single family area, had some success there. I had flipping single family homes. 2008 hit, and man, it was a tough time. I went back into finance accounting and really went down that path for a bit until I knew that, listen, this just wasn't where I wanted to be, right? I knew that I wanted to be in real estate. And my grandfather, accumulated all his wealth through real estate, specifically multifamily, and really started going to events and learning how to do this. I knew that underwriting was more my specialty, and knew, how to underwrite numbers. More importantly, I really enjoyed forecasting. I really enjoyed looking at where the market's at today, where was it at yesterday, and where is it trending to? A lot of people make fun of me. Tyler does, specifically my managing partner. I get into politics quite a bit, right? Because politics plays a part in what happens. Regardless if you like to talk about it, you don't like to talk about it. Politics definitely plays a part in how the market's going. We see what's going on when Democrats came into office, right? Fed Reserve went in, started raising rents. My question would be to you is, how many of you guys are scared of rates and where rates are going?
Nobody. Absolutely nobody. In this room, absolutely not.
Are we going to be able to chat today or not?
So I'll be honest, I'm not positive I've tried to change it on my end, but we
can do it in the Q&A. The Q&A would work. So just use the Q&A to answer your questions that they're answering on there.
Awesome. All right. Okay. Running chat is not our specialty. So awesome. Let's get going, right? Our specialty is underwriting and choosing markets. So if you have any questions, go ahead and put them in the Q&A and we can kind of answer those from there. So that'll be great. Perfect. Where was I at, Melissa? Come on, you got to keep me on track here.
You're talking about rates.
I was talking about politics. I was seeing if you knew. I was talking about politics. Now they play rate. Yeah, exactly. Rates and how they work. What's that?
I said, don't question me. I got you.
Awesome. Yeah. So rates and where are rates at? Let me ask you this. Does it concern you with rates and where rates are going today? How many of you guys on the call, right? How many does it concern you when you're looking at investment opportunities? When you see the media talk about rates and rates going up, how many of you are concerned with that? Go ahead and put it in the Q&A, right? You should be. It should be something that you look into. We passively invest all the time. We want to diversify. We want to put our money to work for us. We put money into deals, right? In fact, the opportunity we're going to talk about is Arden Place and putting our money into deals that we actually present to you all. We put our money to work as well. We want to diversify where we're at. In fact, I went into the bank the other day and they said, hey, Ryan, we have two options for you. We want you to invest, right? One's more of a long-term, one's more of a short-term, right? The short-term was a CD. It was at 3.92%. So I said, man, 3.92%, how should I put it into that? All right, maybe I put a little bit of money into it. I like to diversify. Another one was, it was more of mutual funds. It was at 10.3%, and I looked and I said, the question I asked is, why would I put into your fund, right? Why would I put money in there if it's at 10.3% when our track record's over 20% right now, right? Our track record's over 20%. How do we get to 20%? That's what I want to focus on today. Y'all are looking for opportunities. Obviously, there's close to 100 of you guys on here. You're looking for opportunities for your money to work, right? The bank may not be giving you the returns that you're looking for. Mutual funds may not be doing it. 401ks, IRA, whatever the case may be, wherever your money's at. Crypto, it tanked. We had a couple $100,000 in there. Sure, we feel the pain on that as well. And so we're excited to talk about this opportunity in Arden Place, just north of Atlanta, right? It's in Georgia. Melissa went over the criteria, what we're looking at. Here's the one thing that we look at in a property is just really median income. Melissa, where's the median income here? Do you know it? If not, I'm going to throw it out.
75,000.
70,000. So close. 70,000. It's actually one of the highest median incomes in an area, right, that we go into. More importantly, it's around 46% of the people are renters. Okay, renters, meaning they want to live there. One of the biggest areas when you look into a property and an investment opportunity, right, is, staying out of primary markets. So many people today and operators that you may look at, they're getting into primary markets. They may be getting into secondary markets. Well, guess what? When rates are going up, we want to stay out of primary markets because rents are so high, right? That what happens, people want to commute. Okay, they want to commute. So Warner Robins is outside of Atlanta, okay? And, you know, it actually reminds me of a property we had in the Carolinas. We had a lot of success, okay? We had a lot of success. We were in north of Charlotte, about an hour outside of Charlotte, and people commuted. In fact, we made a ton of money off those deals, okay? So in markets like this, people are looking to travel, okay? They don't want to pay the high rates that maybe an Atlanta market might have, you know? And so being at one of the highest median incomes, rates are about to turn. Fed has no other option. Brian, you're right. You're right. Melissa, I may have to have you say this because I enjoy reading these. I'm getting my ass kicked on rates. David, 100%. Rates are a concern. Oh, you know, I have to scroll down. You guys are writing. I'm used to the chat channel, not the Q&A. But yeah, rates are going up. They're projecting their rates are going to go up again. So when you guys get into a deal, it's important to know when you work with operators is asking the right questions, right? When we talk about a deal such as Arden Place, what are the rates at, right? What are we getting at, right? On this one, we're getting it close to 5.5% on a fixed rate. Okay, why is a fixed rate important? I just had someone ask me this question the other day. Oh boy, the chat's fixed. There we go. There we go. I can keep up with y'all now. There we go. Okay. So, you know, one of the questions we got asked is I like to always talk about the elephant in the room. You know, you guys, you know, most of you guys are sophisticated, high net worth individuals. You know, you're looking at what's going on in the market. Okay. So in Houston, it's no secret, the Wall Street Journal just came out with 3,200 units were just lost. Why were they lost? They were adjustable rates. The LTV was high. Okay. They didn't have enough CapEx to be able to do their properties, right? So when we're looking at deals, those are some of the things that we look at as we prepare and we take down a deal. Aloha from Hawaii. I love it. I love it. Jay says, what's up, everyone? So we like to look at these deals. You know, so in looking at Arden Place and looking for opportunities for us, we want to be extremely selective this year in what we do. Why? Our track record is well over 20%. I see Mr. Fisher's on here. He's invested on several deals with us. Okay. One of the reasons we're able to have over 20%, I say over 25% is really what it is. I would hate to tell you where it's really at. I'm going to tell you where it's at though. Okay. It's at 38% is our track record. I want to tell you though, I want to dig this home, right? Why do I hate saying 38%? Melissa, why do I hate saying 38%?
Because we got to under promise so that we can over deliver, y'all.
Yeah. Well, one could argue it's the market that we're in, right? We sold at the height of the market, which when you get with operators, you want to understand what's their level of understanding of how market cycles work. Okay. What are their levels of understanding how market cycles work? Brian, you just said, hey, listen, rates have to come back down. They do. They have to come back down, but they're going to continue to go up. When are they going to start coming back down? They're going to start coming back down, right? Closer to election time, right?
Wait, Ryan, we are not getting political here, okay?
Yeah. I like
we are saving that for later.
We're saving it for later. But the reality is this, right? The reality is this, okay? When I know what's going on and I know that elections are coming up, you see what's going on in the news today, right? What are they doing? They're negotiating debt, the debt ceiling, right? They're negotiating the debt ceiling right now. What happens is politicians on both sides, okay? They're going to look at where they're at and what they need to do to buy votes. Everything that you see in the media is all about buying votes at this time. Okay. So what does that mean for interest rates? Right. This fast ever. David, you're 100% right. Dan, I know David, and he's invested up in Minnesota. So it is, you're exactly right. Rates have never gone up the side because they had to correct the market, which is hence market cycles. The market had to correct. It was long overdue. The market had to correct. It was long overdue. Okay. So the reality is this, when you look at a deal like Arden Place, why did we look at getting, a fixed loan at 5.5% versus 8.5%? Really, rates right now, if you're getting to a bridge loan that is not done, right, or a deal that's not stabilized, right? If a deal's not stabilized, then you have to get a bridge loan. You should be scared to death, right, if you're getting a bridge loan in today's market. Why? Unless it's a fixed rate, which even on a bridge loan, it's 8%. Okay. The reality is if you're getting
right there. Ryan, do you mind if I interrupt? How many of you know what a bridge loan is? Or how many of you are like, what the hell is this guy talking about? Bridge what? What are we bridging?
Bridge what? It's like something your little 6-year-old would say, bridge what?
Seriously. So how many, okay, there we go. So a few of our attendees don't know what a bridge debt is. Will you share, Ryan?
Yeah, bridge typically is when you find a property that's not stabilized, it's been mismanaged, right? The financials aren't there. They weren't able to accomplish their business plan, right? There's just a huge gap to where we need it to be stabilized, right? If a property is not stabilized, essentially what you're doing is you're going in and saying, hey, excuse me, I want to take over this deal, right? I have to get it to this area right here. Once I get it there, then what happens, you get loans such as Fannie Mae, Freddie Mac, and they can come in and put you into a stabilized debt or an agency debt, okay? So bridge is not necessarily bad. But what happened is a couple of years back in 2020, 2021, people were getting into bridge debts with adjustable rates, okay? They were getting in with adjustable rates and just, anytime you get an adjustable rate with high LTV, loan to value, which means, guess what? They're going to lend you more, which means you don't have to raise as much, okay? You don't have to raise as much, but it could get you into problems, which means that your debt service, your mortgage payment is a lot higher. So what happens is rates continue to rise, like you said, David. As rates continue to rise, then your debt service is going to continue to go up. So is it sustainable? So in today's market where rents have slowly started to go down, right, or what we call stabilized, before they were going up so fast, right, and you were able to charge more and more in rents, well, what happens is now they're stabilizing and tapering off, and so if you were able to keep up with your business plan and you didn't forecast out, right? And that's something we pride ourselves here at MF Capital Partners, is forecasting what's going on. So Melissa and Tyler, everyone that give me crap for getting into politics, but listen, 6 months ago, a year ago, I knew that, this is where we're going. We have, when I say 38%, getting back to that, one of the reasons, Melissa, I hate talking about 38% is rates were so low and I saw the trend, right? We had Biden getting in, right? Regardless of your opinion of him, we knew that rates were going to go back up, right? And so it was then when we made the decision that we were in the seller's phase 2 is what we call it, right? We're at the height of the seller's phase. And we knew that we wanted to sell at that point. So we sell, and some of our deals made 30% annual rate of return, and some of our deals made 50% annual rate of return, right? 50% annual rate of return. Is that a good return? Absolutely it is. How many of you guys would invest today at 30% to 50% annual rate of return? Every single one of you. Hell yes, David. Most of you guys would invest with 15% annual rate of return in today's market. You're looking to make your money work for you. So that's why I don't like talking about 38% return. One of the biggest goals we have here at MF Capital Partners is this, right? The deal that we're about to show you is 18% annual rate of return, right? And it could be a lot better. And we're going to tell you why it's an 18% return. I like it to be fully transparent in what we do and how we do it and how we pick a market. So let me tell you about this, right? What are some of the objections maybe that you all have as investors? What are the objections that you guys have in today's market that makes you a little bit leery of investing? I would love to see that in the chat. What makes you nervous? Go ahead and throw in the chat. Rising cap rates. Let's go. Keep it up. It's 100 people in here. We should get more interaction here. Inflation. Okay, keep going. REIT failures. Yep, David. Yep. Unemployment going on the rise. Yeah, absolutely. Unemployment is going to be an issue. Potential employment issues. Yep. Rent growth slowing down and rising interest rates. Love that, Joe. Rents eventually dropping. Yep, they're already dropped. Perfect. I love some of these. Decreasing rent growth, inflation. Seems like we have some common things, right? Failed syndication. Dallas, I love that one. Failed syndications. I want to spend a minute on that. Why are they failed? Why are they failed? Okay, failed syndications. We just talked about it, right? Adjustable rates going up. Large LTVs, meaning they borrowed too much from the banks, right? And they didn't have a good CapEx plan. They didn't have a good CapEx plan, meaning when they had things that they had to take care of, they ran out of money, right? They had short terms on their loan, meaning they had loans for 2-3 years, right? Instead of 5 to 10 years, right? Typically loans that we look at are 5, 7, and 10 years. The deal that we're looking at right now is 7 years, okay? 7 years. Some of the things we look at in loans, right? For example, in Arden Place, we got 3 different loan options. One was 5 years, one was 7 years, one was 10 years. Man, Melissa, I'm just looking at your backdrop. The MF looks so sexy there, right? Like, come on. I have a Florida Gator helmet back here. David, I just did it for you because I know you're probably a Seminole fan. But listen, my Gator helmet is yeah. Listen, I'm excited for that to come up. But the thing is we look at 5, right? We had 5, 7, and 10-year loans. So I want to be fully transparent on this loan with Arden Place, okay? Arden Place was a 10-year loan, okay? A 10-year loan, with 5-year interest only, 7-year loan, right, with 3-year interest only, or a 5-year loan, right, with 1-year interest only. Which one would you guys pick? 10-year, 7-year, or 5-year? The 10-year had a 5-year interest only, right? 7 had 3, 5 had 1 interest only. I see a 5 there. Ben, absolutely. Bonus depreciation will apply to this one. Absolutely. I see 10 and 5. Oh, 7. There we go. 10, 7. All right. The answer is 7. Why did we pick that? Okay. Why did we pick that? So here's the guesstimate, right? Is most likely there could potentially be a conservative that goes in office next year in 2024. Listen, if you're a Democrat, that's all right, right? Still love you, right? I don't care really about politics. I care about how it does with the market. When Democrats go in office, rates rise, purchase prices go down. When Republicans go in, conservatives go in, right? Interest rates go down, purchase prices go up. We got to learn and know where the cycles are at. But 7 years makes me, makes me look at it is in 7 years from now, that's 2030. The presidential election is going to be 2024 and 2028. So what typically happens? We know that rates are eventually going to change. If a conservative doesn't go in office right now, they're going to probably go into office in 2028, which I know that rates are going to go there. The problem with getting into a 10-year loan is this, right? I'm going to hold that property for way too long, and the prepayment penalty could be, at a place where we don't want to, right? It could be at $1 million, $2 million in prepayment, which could potentially affect your returns, right? Which could potentially affect your returns. So here's the reality. 5-year, it might be too short, right? Too short of a holding period. And 1-year interest only doesn't allow me to get the cash flow, right, to where you guys need it to be. Now, here's one of the things. We always send out surveys to our existing investors, right? What's most important to you? Is it cash flow? Is it equity? Is it a combination of both? I would ask you the same thing. Is cash flow important to you or equity important to you? Here's the thing, right? Cash flow, I don't really need cash flow for me right now. Equity is super important to me. I think, Melissa, you're the same way. Equity is super, super important. Melissa, she's young. She's 33, 34.
Yes. It's the first time you've ever called me young.
Oh, shit. I messed that up. I messed it up. Awesome. Hey, Jay, Melissa, if you see anything in the Q&A too, I just have my chat up is all, but yeah, it depends situational, right? It really depends on the position that you're in. One of the things that we look at too is getting a hybrid model. Really, what's good for both of you, right? Too many interest only, we're not going to pay down the principal, okay? We want to pay down some of the principal so it gets us more equity. So on a 7-year loan, getting 3-year interest only, okay, it allows us to get a business plan and to be able to stabilize this property. Now, Arden Place is a 1983 build, right? So it's in the 80s, right? Something we look at. We used to do properties in the 60s and 70s.
If it was built in the 80s, that doesn't mean that it's old.
Are you saying you were born in the 80s, huh?
In the 80s, absolutely.
Awesome. So these sexy little deals, 114 units, right? It's 114 units. It's a $9 million purchase price, and it was built in 1983, right? Built in 1983. Here's the thing. This is a B-class property, right? In a B area. Awesome. Babies. Charlotte says babies.
I knew I loved her.
Brittany, what do you mean by what is the investment percentage? So here's the thing, guys. 1983 is this. We know that we want to stabilize a property. Here at MF Capital Partners, we believe in 3 phases, right? We believe in 3 phases. The phases are stabilization, then we believe in value add. I always laugh about this, and if you've been on one of my webinars, listen, it's an old joke, right? But I'm a huge golfer. If there's any golfers in here, tell me if you golf. I would love to go golfing with you. In fact, Brett Davenport's on here. I've golfed with him. So the reality is this. There's moving days. Saturday is what we call moving day, okay? And so I like to compare that to value add phases, right? So as we hold on to a property, I like to say the first 6 to 12 months is stabilization. We want to go in on a property that is mismanaged, right? That hasn't been managed properly. So Arden Place, what happened with this? This property was purchased 2 years ago, okay? 2021, what did I tell you? Rates were high, right? Or rates were low, sorry. He bought it for too much. He didn't raise enough in CapEx. So what happened in operational costs, he didn't have enough money to be able to pay things. As rates continue to rise, right, and a debt service, he's going to lose the property. So what this seller did is they did a deed in lieu of foreclosure, right? For those of you that know what that is, obviously he was going to lose the property to the banks, right? So instead of doing that, what he agreed with the banks is, listen, I'll do the deed in lieu of having a foreclosure go on my record, right? And so what's the benefit for us? Well, let me tell you this, right? The properties in Warner Robins sell for about $110,000 a door. We're picking this up, Melissa, for what? $78,000 a door. $78,000 a door. Okay. I want you to do the math for me really quick. I'd love for you guys to interact and do it. This is 114 units. Okay. It's $32,000 a door under the market right now. What is that number right now? I'm going to do this with you. Okay. $32,000 a door times 114. What is that number? Someone throw it in the chat.
But the real question is, did you actually have to use your calculator like the rest of us?
I do. I knew the number already, but there you go. Monty, there we go. 3.648 million. Dallas, don't leave off listen, you just left off 48,000, man. 48,000. That pays for some of my renovation on my garage. Yeah, 3.648 million. Oh, we can't see each other's messages. Gotcha, Chris. Yep. So 3.648 million. Absolutely. What does that mean, guys? Is this? Unfortunately, people that got in at 2021 and they got into bridge debts, you know, the biggest concern I think that one of you guys put in there is failed syndications, right? When you talk about failed syndication, that's a failed syndication, right? People that didn't plan ahead on what was going on with the market, right? They didn't plan on adjustable rates rising. They weren't able to get their business plan implemented or done. And unfortunately, this seller is going to lose the property due to that. We're able to take advantage of that because of the relationships that Lindsay created with the broker here. That's Lindsay Daniels. She does our asset management. She's over acquisitions as well, right? So she established a relationship with this individual, knowing that the Atlanta submarket, right, is one of the top markets. It's actually second best market in the country right now. Second best market in the country. And so knowing that, she wanted to go in and look at tertiary markets that could benefit us. What we've looked at past record in our history and what we've done in areas that we've done well, right? And that's one thing we got together and said, what, you know, where did we do well and what were the similarities, right? In the North Charlotte, North Carolina market, where we had a ton of our success early on, right? We went into tertiary markets during the hard times, right? And we were able to make a ton of money. So what happened is Lindsay went and did the same thing, right? She went and established a relationship with this individual. She's doing constant research in areas of property owners that are struggling with their debt coverage ratio. They're struggling making their payments and they have loans coming due. And what she did, and it's sad to say, she took advantage of that, right? She took advantage of that opportunity. So what does that mean for you guys, right? What it means is this: if we were to go into this property and we were just to stabilize and we were to be able to raise just enough CapEx to do some of the things on the property and we just stabilize this property, what happens when the market corrects? Do you guys believe that the market is going to correct eventually? David, Carey, I know what you're going to say it has to, right? Do you believe that the market is going to correct? You look at 2008 and you look at history. This is what I love. As a grandfather who was in multifamily, right? As in multifamily, right? In the 50s, 60s, 70s, you saw this a lot, right? Really, I was born in 78, right? But you saw in 87, 99, 2008, right? It seems like every 10 to 12 years, something happens, right? 2008 to 2000, really 22, 23 is where we're starting to see things. I really don't count COVID, Melissa. I don't count COVID as that correction, right? That happened. It was an unfortunate event, you know, but really we're starting to see that housing correction now. It had to correct, you know, but really where did people make their money? In the 2008 crash. History says a lot of what we do, right? You know, they were making their money really in 2008. People say 2009, 2010, but as people were losing properties and those values started coming down, as you see Arden Place, just like this example, as you saw, you know, people are going to lose their properties. People took advantage of those opportunities, right? So syndicators and operators that have capital readily available can go after properties like this. So I want you to think about this, right? 3.64 million on a $9 million purchase price, right? If we just stabilize the property, what kind of return would that be, right? We're going to raise $5 million on this deal. $5 million on this deal. I want you to do the math, okay? At 3.642 million, okay, divided by $5 million is what? What percent return is that to investors if we just stabilize? I'm going to help you out here. All right, let's do the math, right? 3.642. Melissa, jump in that calculator. Do it. Do that divided by 5 million. 73%. Gary to the winner. Gary, I'm gonna buy you lunch. Gary, I'm gonna buy you lunch. You shoot me an email. I'll buy
Beat me.
There we go. Karan, there we go. I know Karan. 73%. I love it. I love it. I love Karan. He says 72%. 72.96%. We round up, Karan. We round up. Just like your return, we'll round it up. Unless you want the bottom one, right? You know, that's all right too. Absolutely, guys. 73%. Let me ask you this, right? Do you believe that in today's market, let's say we held this property for 3 to 5 years, would a 73% total return, would that be a good investment for you? Absolutely. Absolutely, it would be, right? I want you to go back to the example that I just said, right? The example I said of going into the bank at Chase, right? Of saying, Ryan, put the money into our mutual fund. Hey, listen, they're great salespeople. Look at, put it into the mutual fund. It's 10.3%. You've got to put it in for 5 years, right? You know, you've got to put it into 5 years, you know? And so I look at 10.3%, and I look at, you take that 73% divided by 5 years, and what's that annual rate of return? It's 14.6%, guys. What do you think about that? That's just holding, stabilizing, and as I tell Lindsay, just don't F it up, right? Just don't mess it up, Lindsay. All you got to do is bring in a management company to just oversee, make sure we have a CapEx. So I want to go into that next step is this. What is CapEx? What is capital expenditures, right? Why is it important to have enough on hand? Well, here's the reality. We don't want just 73% returns. We don't want that. We want to be able to go in on this market. We want to be able to, upgrade the interiors. We want to make sure that rainy day fund, Jose, I love it 100%. I couldn't agree with you more. What's happening with a lot of these operators out there is they don't have rainy day funds, Jose. They don't have those funds readily available, right? And so when I tell you this, I want to be fully transparent about this deal. When I underwrote this deal, I underwrote it at 24% annual rate of return, right? 24% annual rate of return. Why? You know, here's the reality. They're $200. Not only are we getting it $30,000 under, you know, a unit under market, they're $200 under market rent. What happened is this individual got underwater. The seller got underwater. They were trying all their best. They didn't have enough CapEx, which means what? They can't go into the units and they can't upgrade them. When you don't upgrade your units, you can't get the most out of the rents that you really want to get out of it. What happens is operators don't take care of their properties. And when they don't take care of their properties, okay, our tenant's going to want to pay the most in rent. No, they're going to bounce, they're going to get out, and they're going to go to another property, right? And so what we do is we go and we really take care of these property. A lot of people always ask me, Ryan, why do you put so much into CapEx? Why do you have rainy day funds? The reality is I don't ever want to be in a position where we don't have money to where it's like we're forced to sell, right? We're forced to sell. If we're forced to sell, what's that mean for your returns? Yeah, it means that you're not going to get the returns that we promised you. One thing we hear, we like to under promise, over deliver. Once again, this is why I don't like to tell you 38% return, which we could, right? You'll see in our business plan, that's what it is. And that's just a factual number. What I want to do is tell you really where we're at, you know? So when we underwrote this deal and it was 24%, you know, I told Brandon, I told Lindsay, listen, guys, I don't want 24% returns. I want to make sure that we're financially in a place where investors feel safe in today's market and to where we feel safe. So what we did is we bought down, right? We bought down the annual rate of return. Well, how do you do that? What we did is we raised $750,000. In addition to the $400,000 we're going to put into the units, we increased it by $750,000. And I want to explain why we did that. We can use that in a couple different ways. We can use it for CapEx. We can use it for debt service costs, right? We can use it for operating expenses. This covers more than a year of operating expenses. I want you to think about this, and I would love for you guys to respond on this. Do you really feel that the market's going to start to bounce back in at least a year? In 1 year, do you feel that the market, or we'll see some significant changes in the market? Someone said earlier that it has to, right? Do you believe in that a year that things are going to change? Yes, I see 2 yeses. I hope I see 10 more yeses. No, 2 to 2.5. Dallas, listen, you could be right depending on the market, right? I would never say no. It depends on the market. If not, the economy is screwed. Yes. They have to change something, David. David, you need to come into the office. We need to go to lunch. So that's definitely what we need to do is go to lunch. Let's schedule it. Yes, the market's got to bounce back. In some way or another, the market's going to come back. Is it going to come back perfectly? No. Our rate's going to go down? You know, absolutely. Answer your phone. Yes, I will answer my phone, David.
I love that he just called you out on that.
Get all of my assistant. You come to the office, we'll go to lunch. I'll take you to lunch for sure. We'll go to Bella Colina. There you go. I love it. In fact, Melissa's coming with us. She'll get a steak, but she's coming with us. Yeah, we went the other day. I had a filet. I loved it. Anyway, so the reality is this: rates could come down, right? The market could adjust and purchase prices go back up, right? Market rents could continue to go up, and so yes. So what we did is we increased it to $750,000. Some people may ask and say, Ryan, why not keep it at 24%? One question I would have for you is this: would you rather have an operator that tells you 24% and they don't have enough CapEx and then they have to go do a capital call on you? What operator would you guys like to have, right? Would you like to have an operator that puts 750 in addition to the CapEx we've already done away, right? For potential preferred returns checks to you, for distributions, right? For operating expenses, for debt service? Absolutely, that's what we want to do. And so when we looked at this property, we looked at the objections. That's one thing we always look at, is what are the objections that our investors have, or investors in general have out in the market, and how can we resolve those and come up with solutions for those? In finding Arden Place, right, in a B area, right, in a median income of nearly $70,000, right? It's not a median income of $48,000 or $35,000, and the ability to be able to pay their rents. These individuals have the ability to be able to pay rents, right? More importantly, can we get into a market, right, where we can raise rents? Let me tell you how we're going to raise rents. We have a property management company in AMC that we use, okay? Let me tell you about a property we have in Orlando that we closed on in December. What'd you think about this, okay? How many operators do you see out there just closing deals, right? Our last purchase was in December. Here's the thing. We have the ability to close as many deals as we want. Why? We would rather get into the right deals than the wrong deals. I remember Donald Trump, regardless of what you think, saying that in the art of negotiation, right? Or the art of the deal, specifically said the best deals that you can get into are deals that you don't get into, right? Right? The best deals are the deals that you back out of that you don't do, right? And we truly believe that here is we'd rather get into the right deals where our returns can continue to have our investors wanting to put money back in with us, right? And so with that, we wanted to bring in a management company. Nothing here except J's. Jordan's? Probably the wrong J's, Melissa. Probably the wrong J's. But we wanted to get it with a management company who has a proven track record. AMC, right? AMC, they manage a little over 124,000 units. Over 124,000 units, and their track record is 2.6% over their projections, right? What we do is we get with them and we go over our underwriting, okay? We go over what our, the budget. We go over what we call variance reports. We get them to see what the market is currently doing right now. Does it sustain $200 in additional rent? Do we have to do upgraded units? The answer is yes to all those, right? And so working with a management company that really comes in and feels that they can go in and raise the rents to where they need to be is who we want to partner with, So here's the thing, 114 units that we have, right? We've had 63 units. 63 units have been upgraded. That means 51 of those units need to be upgraded, right? Which means of those units, we're able to just gain a lot on the market. Believe it or not, people, they call these homes, right? They call it home, Matt, and they want the properties to be as good as possible, right? And so that's what we like to do. We like to go into these interior units and fix them up, and be able to have these people call home. More importantly, there's a report that came out, about a year ago from, it's an HR report. So HR report said that 70% of the market, right, was it Gen X's or Gen, what are you, Melissa? Generational something, right? Gen Z, whatever, right? Oh. Yeah, and most of them are looking to rent. Why are they looking to rent? They're looking for changes, right? They're looking to be able to they don't want to buy a home and be stuck into something for 20 years or 10 years, right? They want to be able to get into an apartment, right, and be able to stay there and leave when they want. Oh, is the chat working for everyone?
I can see the chat at the bottom of the screen.
Is it? Okay, gotcha. Cool, awesome. And so, for us, knowing the objections that y'all have, right? Knowing that property management, right? Managing CapEx, managing returns, right? Getting into properties that can get you the returns that you want is extremely important to us, at MF Capital Partners. Melissa, sorry, you said, did you have any questions, Melissa?
Me?
Yeah. Okay, awesome. You don't. Perfect. I thought you did. Sorry. So, some of the questions someone asked is really, what is the debt service? I think someone asked that. Where are we at with the debt service? One of the biggest things is this, right? And I'll get into bonus depreciation and how's that look for you guys, because someone had that question, is this. One of the things we believe in today's market is putting a substantial amount of money down, right? And so it's a $9 million purchase price. Okay, we can send you over the sources and uses. In fact, if you guys are interested in the opportunity, I'm sure that we have a link there, Jay, that we can post, right, for people interested in this opportunity. Some of you already know that you're interested in investing in this opportunity already. Yes, Joe, it is part of the Aloha Fund. We can get into that as well. But what we...
And on that note, we actually have had a couple different investors ask if we are investing anything into this deal. So if you want to kind of touch on that as well.
Yeah, we're almost putting $500,000 into this deal. So absolutely. Once again, we talk about letting your money work for you, okay? In a property like this, you don't see property like this too often out there in the market. You just don't. We took advantage of someone who was, a deed in lieu of foreclosure, right? Who, we're getting for $30,000 under the market. The market, like I said, is $110,000 a door, right? We're picking it up for $78,000. So for us, getting into an agency debt right now, in fact, someone asked, why are you not getting into a bridge loan and fixing it up and not having to borrow as much, not having to raise as much? One of the biggest things is, guys, is people are losing their money because they get too high of a loan to value. We don't want to be in that position. And so what we're doing is we're putting a little bit more money down. What does that mean when we exit? The projected exit over a 5-year period on this is 18 million, 18.367 million to be exact. Okay, I want you to do the math there. We're buying it at 9 million. The exit value is 18 million. Okay. $18 million. Okay, so that's a 5-year hold. Most of you guys have invested with us. Trevor Fisher, I see that you're on here. Most of you guys know that we've never held a property over 3 years. Never held a property over 3 years. Why? Because we get mismanaged properties. We get properties like this that are not only $200 under market, but we get them where they're $30,000, under, where the market is in that market, or sorry, 30,000 a unit under market on purchase price. Sorry, Melissa, I just lost my train of thought. No, just kidding. So we're putting approximately 45% down on this property, guys. So we have a 55% LTV. Why did we do that? Okay, Joe, I think you probably asked that. Why did we do that? Here's the reality, guys. We want to get into fixed debt right now. Our interest rate's going to continue to go up? Yes, they're projected another 2 or 3 times to go up again. Why did we do that? Okay, once again, we got into a 7-year loan, 5.5% interest rate on this deal. Okay, we'd much rather get into that rather than 8%, 8.5%, sometimes 9% on a bridge debt right now. What does that do? That eats into you guys into your cash flow. That eats into projected preferred return. Once again, I said we like to look and see exactly what investors want. Okay, getting into an 8% interest loan rather than a 5.5%, it doesn't give you guys the returns that you're looking for. Okay, it doesn't give you the preferred returns and cash flow in today's market. It allows us to pay out a lot quicker than we typically do. So this loan on the LTV is 55%. We're putting 45% down. Like I said, we have $400,000 in CapEx with an additional $750,000 we're putting off in reserves for potential operating expenses, debt service, or as someone said, a rainy day fund. So I would love to actually have this be interactive and have any questions you guys may have on Arden Place before I start to go on. I would love to answer any questions y'all might have.
Brian asks, what is the deal cap rate? What is the assumed exit cap rate, rent growth rate, and occupancy rates?
Ooh, you're gonna have to go one at a time.
So what is the deal cap rate? Let's start there.
Yep, the deal cap rate, right, is at 5%.
And what is the assumed exit cap rate?
Assumed exit, we actually did it at 5.4%.
And then what is the rent growth rate?
Rent growth rate, right? So the year over year in this specific market is over 12%. Okay, that's a great question. Who asked the question?
So I have it in here in the Q&A under Brian.
Right, awesome. So here's the thing: is 12%. I'm glad you asked that question. One of the biggest areas that people get into trouble is they go into markets. Let me give you an example. We own 4 properties in Houston. You had the market rent growth back then was close to 12%. I think it was probably 10.5%. And a lot of people said, why didn't you underwrite in your underwriting closer to 8%? You can get more aggressive and push it up. Well, I knew where things were trending. Okay. In today's market, you're looking more at 6-8% in market rent growth in that specific market. So here's the thing: if I would have underwritten the deal at 8%, I'm at the top of the market, meaning I really have to be doing a lot, to those interior units, or I have to really be doing a lot to there to get the max rent out of that property, or I have to have a damn good property management company. Okay, I have to have a damn good property management company. And so the reality is, I don't ever bank on doing the best. We like to say that we're conservative. I always like to go in half of exactly where we're at, or close to that. So we're doing it at approximately 6% market rent growth. Once again, Brian, what we do is we get with our property management company. They look at historical data. Once again, they have over 124,000 units that they manage and operate. And so we really work with them in understanding before we even submit over a letter of intent to get this deal is, can they accomplish what we want to accomplish? So we're at 6% in market rent growth, which, like I said, Atlanta is it's the second best market in the country. This is a tertiary market. And it's over 12% in market rent growth on it. So I love that question. What was the other one on it?
The last one was the occupancy rates.
The occupancy?
Yep.
Did you say raise or a rate?
Rate.
Okay.
Are you trying to say that I have a list or that I have an accent? Because I do.
Welcome
I kind of have a hick on the sticks accent.
Yeah, it's at 94%. Stump me with something else, Melissa. Come on. 94%. What was the other question?
When does the opportunity?
What's that?
When does the opportunity close? Ben just asked that in the Q&A.
Awesome. No, I love it. And someone asked what the DSCR is. DSCR is at 1.26. So obviously qualifies for agency. Thought great question there, right? It's important to know where the DSCR is, meaning, am I able to go and pay that? Okay. What was that question you just asked on it?
When the opportunity closes.
Yeah, here's the thing. We close on the property June 12th. Okay. So the reality is this: when do you need to have your funds in by? June 6th. Okay. This is a quick close on this. Believe it or not, we already have half of it raised. We're putting in $500,000 as well. We already have half raised. This is, like I said, guys, this is not an opportunity that you see out there often. Okay. This is not an opportunity you see out often. Not where you're getting at 30,000 under plus a $200 under market rent. You're not going to see opportunities like this often. Brian, what is DSCR? It's a debt service coverage ratio. Okay. It tells me where am I at as far as NOI goes to be able to pay my debt service or my mortgage. Okay. You want to be over 1.25 in order to get fixed or agency rate. It says if the property is stable or not. So the minimum investment is $100,000. Yes, this is a great question. This is for accredited investors only. Okay. So if you don't know what a credit investor is, make sure you get with them.
But we do have an opportunity. If you have anything less than 100,000, schedule a call with our team. We are able to accept some on a case-by-case basis if it's less than 100.
Joe, great question. Do your returns start on the fund after the fund closes? No, it's actually as we close on deals. So it's more important to get into the deal quick, right? For example, we have Orlando Sky that we closed in on December, right? With AMC in there, we're already over 17%, where we're at. We're actually closer to our 2 and 3 year numbers. Mind you guys, we have Lindsay Daniels, who's overseeing this property, who oversaw 54,000 units. She's our asset manager on this. She's over acquisitions as well. This girl knows her stuff, right? She knows her stuff and how to do it. So we literally, on this deal, yeah. So she's going in and taking over. So it is on Orlando Sky. She went in. I had a little bit of a brain lapse there, Melissa. You probably caught that. Thanks for not throwing
brain fart.
You typically give me a lot of crap on this, right? But
trying to be nice.
Yeah. But the thing is on Orlando Sky, she's in just 5 months. She's at almost where we're at in this, almost the end of the second year. So for those of you guys invest in Orlando Sky, looking at the numbers, right? Looking at the numbers, and just, I think it was 3 months into that deal, 4 months into it, what they went in and did immediately out of the gates. For everyone that invested $100,000, it was already $8,000 in equity that was created in just 3 or 4 months, right? They went in and started raising rents right away. That deal was $300 under market rent. This deal is it's over $200 under market, but that deal we didn't pick up $30,000 a unit under market rents, under market. Awesome. What were some of the other questions? What kind of cost seg deductions are you estimating?
Wait,
Gary?
before you dive into that, Ryan, will you, Charlotte just put in to clarify, it's part of the Aloha Fund. The investment is specific to Arden. So Ryan, if it's okay, I'll answer that one.
Yeah.
So because the Aloha Fund is acquiring Arden Place, if you invest in the fund, then you have a piece of Arden Place. So as long as you're invested into the fund, then yes, Arden Place is part of your investment portfolio. And you get to benefit from everything that we've talked about today.
Awesome. Can I answer Gary's question on cost seg? I actually love this. We've already engaged. We close on the 12th. We've already engaged with, we have Ari Beard, with Lindsay, already engaged. That I'm telling you guys, this is about our team, man. We like to forecast and get ahead of it because we know that that's important to you. It's important to us. We put our money alongside with you guys, right? So it's important to us that we get cost seg or bonus depreciation on it. So in calculating where we're at, we should see anywhere from 30 to 70% on this. Mind you, bonus depreciation cost seg this year is 80%, not 100%. Okay. So that's why I say it's a range between 30 and 70% of what we should see of the equity. It should be right around 3.5, maybe 4 million. Obviously, they got to get on site and be able to do the study. That's about how much we should see is anywhere between 3 and 4 million, I'll say, of actual losses or accelerated depreciation. For those of you who don't know what cost seg is or bonus depreciation, you high net worth individuals will actually know that, right? But here's the thing: when you sell a property, or when you make your distributions, you don't want to pay tax on those, or any passive investments that you have. You don't want to pay taxes on it. Melissa, here's the thing: I'm not a tax professional. She's going to remind me. I'm not a tax professional. So this is what happens with us, right? I always say that. I have to make sure I clarify that. Big disclaimer on that one. Okay, so the reality is this is how it works for us, is we want that depreciation on any of our passive investments. We don't like to pay taxes. We don't have to. So this one, it should be anywhere from between 3 and 4 million. Told you it's a $5 million in equity that we're putting into the deal altogether. That's down payment, CapEx, all those. So we can send over sources and uses of how we use the money as well. But that would depend on what your ownership into the property is. So, hey, I would say get with Melissa or one of the team on the investment specific opportunity. There definitely could be opportunity for that. Yep. So the Aloha Fund, I'll tell you this. A lot of people say, I want to get specific opportunities. What's amazing about the Aloha Fund is this, right? We go out and get a ton of mismanaged properties. We put them into the fund. For example, Orlando Sky was $300 in our market rent. We're already seeing a 17% of where we're at. It's almost the end of second year of where we're at with that specific property. Lindsay, you may kill me later because I may be, actually, I think it's it's actually 19%. Lindsay, you can send me a text really quick. I believe it's actually 19% now. She actually did correct me on that the other day. 19%. So 2% is actually a big, definitely a big number in this. But the thing is that was $300 on market rent. Let me ask you this. If you can have 4 or 5 properties in the fund that you own that are mismanaged, here's what's beautiful about it. What happens if you were to put into one deal and it didn't perform as well, but you have 3 others, say we have 4 deals. One of them was maybe 14, 15%, but the other ones were 25, 30%, right? Would you rather be in a fund that owns 4 properties or one specific deal? Me, I'm all about diversification. That's one of the purposes that we created the Aloha Fund, is diversification. Some are going to cash flow well. Some are going to have great equity, right? But combined, the total average return is obviously a lot better than if we were to get into one property, right? That's why we created the fund.
Brian, to your point, I mean, some of you on here are active investors, so you're actively finding your own acquisitions. So to Ryan's point, what happens with the fund is you now have 1,100 units in your portfolio, as opposed to the 114. So when you invest into the fund, you now have this portfolio to share as you're working with brokers and lenders. So that's also another perk.
I love Jose's answer. I would love to hone in my capital raising skills. My name's Ryan, not Ray, but that's okay. Jose, I'll forgive you.
Call him Ray. Please, for the love of everything holy, call that man Ray.
I say that. Don't call me Ray. Don't call me Ryan. Just call me Ryan. That's my name, R-Y-A-N. Melissa and Jay. Awesome. I love that you can laugh about it, Jose. Awesome. I'll tell you, one of the best things about capital raising is this, guys, right? Is present opportunities, identify what the objections are, and find a product that your investors want, right? Find a product that your investors want. We know that Arden Place, Orlando Sky are properties that our investors want. Specifically Arden Place, making sure that, listen, not only did we get it at a good purchase price, right? This deal could have easily sold for 12.5, 13 million, easily. Okay. We were able to pick it up because of someone else's, someone else's default, right? Someone else's, just mistakes that they made. They didn't properly plan. They didn't forecast, right? So we were able to pick that up. Something that's $200 under market rent, the insurance. I want to touch on that really quick. So many people are concerned with insurance. We're picking this up at almost $900 a door, where the rest of the market is $1,200. We have an umbrella policy that helps us control these expenses. One of the other things I really love that I didn't point out, Melissa, either, is this. One of the biggest things that people are concerned with is taxes, right? Taxes going up. And if you're in the Texas market, those go up every year, and they've been just tremendous, right? They've killed people. Someone asked, why are you guys getting out of the Texas market? We're not necessarily getting out of the Texas market. We love the DFW area, right? But the reality is this, in this specific market in Georgia, in this county, they reassess every 3 years, right? Every 3 years. So what does that do for us? It allows us to control our expenses, to be able to project out how cash flow is going to work. Your property taxes is one of the biggest things that's going to kill a property, right? Here's the thing, depending on the valuation and the caps of taxes, it could absolutely kill you. I'll give you an example. My personal home here, taxes are almost going to double this year. Why? DeSantis, look, he was a beautiful guy. He is a big old thing with Disney, whatever, right? I live in a county that is actually, they're doubling almost their taxes. David loves this too. I know, that's why I'm moving into Lake County, David. Anyway, I'm moving back to Lake County. So David actually gets that. He's here in the Orlando market. So anyway, we love the fact that we could get into this market, right? And it reassesses every 3 years. Those guys, it's going to get you. It's going to literally get you, And so what we've done is we actually went and projected in the year that's going to reassess. We've gone in and updated those numbers of what the taxes should be, so that when we get into it, we went over 3 phases. I'll end with this unless there's more questions, right? Here's the reality. We like to stabilize the property on this. We're going to go stabilize it in the 6 to 12 month period. Okay. After that, we're going to ramp up rents as fast as we can. Now, just like Orlando Sky, we're ramping up rents immediately. As those leases terminate or they expire, we're going to go and raise those to market, which means we're going to get an instant $200 bump there. Okay. This is in a conservative state. So we're able to go, as opposed to like a California market, we're able to go in and raise those rents all the way to market. Okay. We love those opportunities, right? And so, excuse me, getting into that and being able to do that, Melissa, I see you just laughing at me here, just laughing. So
I won't give you the crap.
No, don't give me crap, but being able to go in and know that as we stabilize, as we raise the value add, typically in the 18 to 24 month period, we're looking at exiting, right? We're either going to look at refinancing or selling a property. Okay. And so we prepare and we forecast out, where's the market going to be in the next 6 to 8 months, 6 to 12 months, so we can prep for a refi or sell the property. We want to get your money back to you so you can put it into another deal and work. Someone asked and said, hey, listen, why would we not get it and have it just cash flow continually? Why? Because we want meat on the bone. We want to get into properties where we can accomplish our business plan, right? Make sure we take advantage of that $200 under market, right? A unit, absorb all of that and then take that money and put it into another deal. We want our money to work for us and then take it in and make even more money. That's how we've been able to keep our track record and the returns and underrated returns where they're at. Melissa, are there any more questions? I would love to answer some more questions.
I think we got all of them, unless I missed them.
Let me ask you this. I would love to know this. How many of you, by a show of hands, thumbs up, whatever, yes, you can say whatever. How many of you guys are actually interested in a deal like Arden Place? I know they're few and far between. How many of you guys are interested in a deal like this? Absolutely. And I would hope most of you, right? You're just not seeing deals like this. This is why I'll be honest with you. I'm very selective in the deals that we do, and Lindsay's very selective in the deals we do. They have to fit a certain criteria that we have in order for us to do that. She did an amazing job, her and her team did an amazing job at identifying an opportunity for you guys that would allow us to keep our track record where it's at, right? Once again, it's under promise, over deliver. Our goal, like I said, 18%. We want to always do over 18%. We're never going to tell you, hey, look, this is what we did. That's what we did yesterday, right? That's what we did yesterday. We want to focus on doing always over the 18% that we're talking to you about, okay? And we do it by some of the things that we talked about today, of being able to get those numbers where they're at. Here's the thing I want you to think about this is Orlando Sky and what we did. A lot of you guys are asking about the Aloha Fund. Orlando Sky, okay, it was a bridge loan, right? We had an example of a business plan that we wanted to execute. And this is how well AMC and Lindsay and her team have gone in and done this, okay? We're $36. We are over $100, right, off of being able to get our debt coverage ratio where it needed to be to get into an agency debt, okay? So I want you to think about that. The deal that we underwrote, it worked at 8% on Orlando Sky. Why? Because it was $300 under market rent, okay? What the exit strategy, someone just said what the exit strategy is. With that one, we wanted to refinance and get some return of capital back to you, okay? This one, now we were over $100 off from being able to hit our debt coverage ratio. Today, we're $36 away a unit from being able to hit it. That's how quickly that Lindsay and her team with AMC has gone in and be able to achieve the numbers that we wanted to. So for those of you that this is your second or third time on a webinar and you did not invest in Orlando Sky, I'll say shame on you, right? You did it out of fear. You did it off the market, right? You did it based on thinking the interest rates were going to go up, you know? And that those are all common. Those are all natural human instincts to say, hey, listen, this is what's happening. But guess what? You have operators that are always planning and preparing and forecasting out. We would not have done Orlando Sky at 8% if the deal did not work. If we didn't have a solid plan in place to be able to do that. When you're $300 under market rent and you had a lot of those leases that were terminating, we knew that we could go in and raise those rents as quickly as possible, right? And so that's how we're able to do that. That one in the next 6 months, you know, we're actually sending over to our lender right now to see exactly what we need to do. And I know Lindsay just did that last month. That's how she knew we were $36 away. We'll continue to send over our financials to make sure we can get to agency debt. So I want you to think about that. We're 19%. Lindsay, I corrected 17 to 19, right? The reality is this. You gotta love technology, right? She shoots a quick text. You know, the reality is this, is when we go from 8% to 5.5% on those interest rates, what does that do for the preferred return for you guys? It just increases the ability to pay cash flow out. That's a substantial amount of money. It's a substantial amount of money. So that's exactly what we do. We're always planning. We're always forecasting out to be able to get you guys a return. For us guys, it's about investor experience. Every decision that we make is about investor experience. It's not about us as general partners, right? It's not about what we make. It's about what can we do to make you guys the most amount of money so that you continue to invest with us. We see that there's a lot of investors who invested with us previously. They're on this call because they want to know about these opportunities because we delivered on what we said. So listen, if you're interested in the opportunity, Jay's been posting the link on there. I've got a time for one more. Is there a pitch deck for Arden Place? Thought you can get with Melissa, right? Schedule an appointment, get with Melissa. She can go over that with you, definitely. Awesome. So I saw a lot of thumbs up, a lot of yeses to would you invest in this deal, man? We look forward to talking to you about this opportunity, right? And about you guys investing. Like I said, critical dates on this. I like to go over critical dates. June 6th is the last one. We've raised over half the money for this deal already. Okay, we've raised 2.6 million on this deal already. Okay, we've already got quite a few saying that you want to invest, save a spot for you. So the reality is this is going to fill up fast. Like I said, key major points, right? Taxes reassessed. We can control the expenses. It's $30,000 under market, which is what? 3.642 million, right? Not 3.6, but 3.642 we said, right? $200 under market rent. And we have a kick-ass property management team that's going to come in and be able to establish our business plan. The other one is this. It's a 5.5%. We're already in a stabilized stabilized loan on this deal. So you got 4 or 5 points right there of why you should invest in this deal. You know, we look forward to talking to you guys. Listen, if I can hop on the phone, Melissa, any of our team members, look forward to talking to you guys.
Thanks so much, you guys. We've just thrown so much information your way, but if you have any questions at all, again, the first step is to create your investor profile. That way you have access to all of these incredible deals. Now you can do that by following the link in the chat. And if you have a question, my calendar link is in there as well. Let's jump on a call. Let's go over what it is specifically what you're looking for so that then we can help you really make that decision and identify what is the best opportunity for you. So we're so grateful that you guys jump on with us on a Wednesday afternoon. It's so great to see. I would love to see your faces, but second best is your names. Thank you for joining with us. Again, any questions, please reach out to the team, but we're so grateful you guys are here. You guys have a great afternoon and a great rest of your week. Have a great night, guys.
Maybe not here.